Now, I don't often do this, but I think I'm going to recommend that all of you who are listening to this go and check out a video from George Gammon. He just posted it up yesterday, and I wanted to give my thoughts on what he discussed because I thought that it was very interesting, and it was something I hadn't considered, but I think it's important for me to mention it as an addendum to my 3 videos on the financial markets and the economy that I put out this week. Because if lo and behold, if what he's warning about ends up coming true, well then I want to make sure that I have that on this channel so that I don't look like I'm totally caught off guard by it. Because it's quite possible that while I do think that the reasons that the bond market is seeing some trouble right now, the reason why yields are rising, why interest rates are rising, as I've been discussing, I think that there are very real reasons for that, and it's going to continue for the foreseeable future. I think that George Gammon makes a very interesting case as to why, in the short term, we might see a short squeeze in the bond market. And of course, what that means is that bond prices will rise and interest rates will fall. But again, he didn't say this, but I contend that what he's describing would be a short-term phenomenon because, by the nature of a short squeeze. Short squeezes are something that you get when markets are moving down. You don't see a price in an exchange traded market of any kind that moves straight down or straight up. On the way up you get corrections, and on the way down you get short squeezes. But as I think a lot of normies and I guess bright-eyed and bushy-tailed young speculators had to learn from the GameStop short squeeze. A short squeeze does not mean that the price of an asset is going to go back up long term. Short squeezes are very violent, but they're very short-lived. Now, what Gammon highlighted, which might be evidence that a short squeeze in the bond market could be on the horizon, is the fact that a couple weeks ago now, repo rates started to go negative. Now, this is opposite from what happened in the repo market back in 2019, which I discussed quite a bit at the time. That was what I termed the repocalypse. And back then, the repo rate, spiked up to double digits, up to 10%. And, if you get to that point where repo rates are in the double digits, there's not going to be much money moving in dollar terms. And so that was a big problem that the Fed had to come in and start doing QE again to solve. But now that repo rates are hovering around negative, or hovering around zero, briefly going negative, I couldn't find a good data source for day-to-day updates on the repo rate. So I don't know how far above zero repo is trading, this week. But a couple weeks ago it did go negative, and there were plenty of news outlets that reported on it at the time. Now, just I guess as a quick review of the repo market, the way it typically works is some financial institution, hedge fund, bank, what have you, has bonds, but they don't have enough cash, and they need cash to settle trades and things like that, and keep their business open, because these banks are always levered to the hilt, and they don't really keep, they don't keep a lot of times they don't have enough cash on hand to run their business day to day, and so they have to go borrow it short term. And so they borrow cash by putting up some of the bonds that they have on their balance sheet, whether they be mortgage-backed securities or other kinds of asset-backed securities or U.S. Treasury bonds. They put these up as collateral to borrow cash. And if the repo rate is going up, that means that there's a scarcity of cash, which is why the Fed restarted QE back in 2019. It's because they saw, the repo market doesn't have enough cash, interest rates are getting high, and so there was a supply-demand imbalance where there was greater, you had a bigger supply of bonds relative to cash. But now, if repo rates go negative, then that's the opposite effect, to where you have an imbalance between the supply of bonds and cash, but to where there's more cash than there are bonds. You have lots of people willing to loan money, and not enough bonds to be put up for collateral on these loans. And the way that repurchase agreements work is that these two assets, the cash and the bonds, they change hands. So the lender of the cash gives the cash to the person who's putting up the bonds, and they take those bonds for the period of term of the repo agreement. And so in effect, the cash lender is borrowing the bonds for the term of that repurchase agreement. It can work. The repo agreements can work both ways. And so for rates to go negative, what that would mean is that generally speaking, you're going to have overall more cash being brought and people searching to borrow bonds than the other way around. Cash, in that sense, is going to be less scarce. It's less liquid than the bonds. You have more people wanting to borrow bonds than who want to borrow cash. Parties in the repo market, for whatever reason, prefer holding the bonds to holding the cash, and so therefore the cash is going to trade at a discount to the bonds. And normally, logically, this would work the other way around, to where bonds trade at a discount to cash, because, what is a bond? A bond is a promise to pay you cash in the future. Whereas, so you would think that, a $10,000 bond would trade at a discount to $10,000 in cash, because the $10,000 in cash you have right now, the $10,000 bond, you have to wait for it to mature to get your $10,000. So the only reason why this would happen is pretty clear. It's an indication that there's a lot of people trying to short the bond market. The reason for this is that it would make sense that you'd be willing to, that bonds would trade at a discount to dollars if people are able to take those bonds and sell them short and then buy them back later because the price of bonds is falling, at a lower price, right at the end of the repurchase agreement, and then pocket the spread. And so in that sense, let's say you're able to sell a $10,000 bond, buy it back in a week later for $9,500. Well, there you get to pocket $500. And if in that time you have to pay $250 in negative interest, well, what do you care? Because you still made $250. You're making a profit then. So you can justify paying the negative interest rate as long as the rate of return over the term of that repo agreement is greater. If bonds are falling at a greater rate than whatever the negative interest rate is. But if by some miracle over that, let's say, week or 2 week span of your repurchase agreement, the price of whatever bonds you borrowed actually goes up, well, then you're going to lose money. And then on top of that, you have all of the shorts coming in and having to buy up those treasuries so that they can, complete the repurchase agreement. They have to cover their shorts, and that puts even more upward pressure on the price of these bonds because people are having to buy them back. And so a negative rate in the repo market creates a lot of risk for a short squeeze in the bond market here. Because if the repo rate was stays positive, well, let's say the price of bonds goes down in that week, you have a little bit of a cushion in the positive rate of interest that you're being paid by the person who's borrowing cash for you and putting up those bonds as collateral. But even still, a repo rate that gets, the closer the repo rate gets to zero, the less of a cushion you have. But the point is that if that rate is negative, then you have zero cushion. In fact, you're kind of it'd be more like sitting on pins and needles if you have a negative rate, because you really have to make sure you make money in order to make up for that negative rate of interest. And so what reason could there be that we might see a sudden spike in bond prices, a sudden plunge in yields that could, I guess, just start this short squeeze, kick off this short squeeze? And Gammon's answer to this, what might cause this, is the fact that Janet Yellen, and this is something that I should have mentioned earlier in the week, but which I forgot, Janet Yellen made it clear that this next stimulus package, this 1.9 stimulus package, is going to be largely paid for out of the Treasury General account, which is something that I haven't discussed since like November, because I was talking about how I thought that back then, when they weren't going to do a stimulus bill, when it wasn't going to get done, that Trump might, for political purposes, spend all this money that they have saved up in the Treasury General account, which is, essentially the federal government's checking account at the Fed. They might decide to spend this money without congressional authorization because the federal government already has the money. They don't have to go to Congress to get it. They can, essentially spend it on whatever they want. Ultimately, that didn't come to pass, though, so that $1.1 trillion is still sitting in the Treasury General account. And so rather than going out into the bond market and issuing $1.9 trillion in debt to pay for this big stimulus bill, Yellen is saying, well, we've got $1.1 trillion sitting here, so why don't we spend that first? And so in doing so, what Yellen will be doing is moving $1.1 trillion off of the balance sheet of the Federal Reserve and onto the balance sheet of the commercial banking system. And if repo rates are already negative or close to zero, well, then what that means is that there's a relative glut of cash, of U.S. dollars, in the commercial banking system already, relative to the the supply of Treasury bonds. And so this has the opportunity to, in the short term, increase the the supply of cash in the repo market even more, and therefore, if the rate is already zero close to negative, drive it negative or more negative. And if the repo rate is negative, well then, that is going to create a demand for Treasury bonds for people who want to go out and buy Treasuries and then loan them out in the repo market to make a positive return. And so, to the extent that the repo market is negative, that's going to drive buying in the Treasury market because, like I said, they're going to buy Treasuries and loan them out. And so this would then drive the price of the Treasury bonds up, and that would, there's your short squeeze. But, of course, in the long run, this would not be sustainable because the underlying reasons why people were shorting the Treasury market are still valid. This is not going to make just because there's a short squeeze because of the repo rate going negative in the Treasury market does not mean that inflation is going away. And inflation, I would argue, is the underlying reason why people are shorting the Treasury market to begin with. Because the inflationary pressures are being put on consumer goods. And of course, they've been put on asset prices for years, but nobody considers that to be inflation. And so I want to make sure that I lay this possibility out, because if there is indeed a short squeeze in the Treasury market, we need to look at this theory and see if this matches up with when that comes eventually, to see, okay, are rates falling this week because because Yellen dumped a bunch of money into the banking system, or is it because inflation expectations are actually falling? And depending on which one of those it is, let's say that it is because inflation expectations are falling, then we'd still have to figure out, okay, is this realistic? Is this accurate? Is there going to be less inflation than the market's thinking now? Really, there's an infinite number of moving parts here, and it's very hard to keep track of it all. But I thought that this was a very interesting and novel idea, and so I wanted to go over it. But for a more full explanation, you should check out Gammon's channel. I'll link to this video in the description so you can go see it. And so I think that'll be all for today.